Hello, ladies and gentlemen, and welcome back. Are the bulls about to return? We've just seen Nvidia getting banned in terms of doing exports to China, and this has sent markets straight back into an incredibly important zone. Resistances and supports. We've got gold, we've got S&P 500, we've got Nasdaq, and many stocks all at critical points. So are the bulls going to come back in this range, or is it just going to be an absolute bloodbath moving forward all the way back into the dips? We've got a lot to discuss today, and of course, a lot about being patient into probably what's going to be the catalyst for all of this, non-farm payrolls. Stay tuned, everyone. We'll see you very soon. All right, well, welcome back, everybody, to the Daily Show where we talk about stocks, commodities, and cryptos. We'll start off here. Nvidia stock drops in after hours after the US limits exports to China. Military end use is the key. It's a big deal. Of course, it's sent shockwaves through one of the most powerful sectors in the US stock market, being semiconductors. And this is an interesting chart that I shared on our Twitter. Follow at FX Evolution if you're interested. Nvidia, look at this. One of the most shorted positions out there in the markets. Now, it's partially due to valuations, but I'm sure they're happy with their short position right now because, of course, it's been hit in after hours, going back down to the lows of 141. So where are we at the moment in technology in terms of seasonality? We've discussed midterm election years. We've discussed weakness from the middle of August into the middle of October. Obviously, it's a kangaroo style market. You'll see why as we go through the macro data into, of course, the charts a little bit later on. We'll skip through some of these very, very quickly. XLK seasonality over the last 100 years, you'll notice this is the worst time or the worst period for it. Generally, it starts to pick up start to middle of October if you were to look at dates and times that do the best. That's being said, what about some of the things to do with the 200 SMA? This was in our special video discussing the 200 yesterday. We'll leave it as once you get underneath this zone, which we did in the previous session, you start to play with some pretty bad statistics towards the bull side over the next 2 to 3 months. 30% really across the board there in terms of bullish case scenarios. The same thing with the 200 SMA and MACD. When we see these things cross and we see them cross down, again, watch our previous couple of videos if you're interested more in this. We get those 1 to 3 month kangaroo style markets with mostly negativity around the stats. And that's what we're currently seeing. We know the bond market is telling us the US is in a recession or it's going to hit a recession soon. Of course, the words change all the time. The most important part about this is really what we can then figure out in terms of correlations in previous histories. We've got the midterm election years here, all other years. Again, weakness in this August into September into October period is very, very common. Well, why is it common? Because the big wigs, they come back from their holidays in the Hamptons. They need to pay for the lobster dinners, the lobster lunches, who knows what else. All of those yacht trips they've been taking. We need to pay for it. How are we going to do it? We need to create some volatility. And all of these stories are starting to mount, as we've discussed now on the channel for a little while. Midterm elections, seasonality, weakness in the market, inflation out of control, yields just hit new highs. All things are occurring. In both the bull and the bear correlation stories, as long as there was a recession, or at least there was a recession in the future, we usually saw the double dipping. That's what we're starting to see now in these markets. Whether we go double dipping into bull cases, we don't know yet. And of course, the bear cases in terms of correlation are incredibly brutal. So if you are a bear in these markets longer term, you could be looking at a lot more blood if those correlations come true. So just before we jump into the charts and look at the key levels that you need to be watching right now, I'd like to thank the sponsor of today's video, which is Tiger Brokers. Now, Tiger Brokers offer a whole bunch of analytical tools. We've got short covering. We have, of course, the fundamentals, the PE ratios, level 1, level 2 data, so many things. But also they have a great charting software. And you can see here a familiar kind of charting software, which provides so much extra information. Earnings is down the bottom on the charts. Volume is present. We've also got split information present on the charts before it happens. But most importantly, we can also do all of our charting techniques. So if we go up to the top right-hand side, you can select from here moving averages, Bollingers, stars, EMAs, VWAPs, really MACD, any of those kind of major indicators that people like. One of my favorites on the channel is always to talk about volume profile. And you'll notice that if you're a scalper or a day trader, you can get the volume profile for your daily trading needs. If you have a support or a supply or a demand or a support or resistance level, you can add your volume profile and then see whether they line up together. Confluence is the key when it comes to trading. You can change your appearance, colors, and more importantly, all of your charting techniques and timeframes can be found on the top left-hand side. If you're interested in finding out more about what Tiger Brokers can offer you, there's a whole bunch of different links in the description down below today with special offers for members of the community. So why not give them a try and check them out today? Okay, guys, let's get into the charts because there is so much to discuss here. We'll jump through a few and then we'll go into the key levels that we need to be watching. The VIX here, 25.86, still in the middle. We didn't really see a huge jump in volatility, but where we did see a movement was the US 2-year, 3.5%, a new peak on yields, really pushing the market lower along with that Nvidia ban on some chip kind of exports. All these types of things, they're reminiscent of 2018 in my mind, where we saw that kind of potential trade war starting to happen. Is this the beginning of that and further weakness to come? We also saw things like inflation numbers start to come out of Europe and they didn't look very healthy, and that led to the US dollar also finding some strength over the last couple of hours. So it's really catch-22 here, and you'll see why when we talk about the US dollar. We're at a key resistance. We could easily be in what we call a Wyckoff style scenario where we've got a buying climax, a UT, potentially a UTAD coming, and we need to keep our minds and options open to this setting up as what we call a distribution. Now, if it is a distribution, it's going to make sense to a few other potential commodities, specifically gold, that we'll take a look at in a second. But yes, the US dollar is currently still bullish in sentiment, still bullish overall. There's no reason to say that you're against the US dollar yet, but we need to be wary that this is becoming a dangerous and crowded trade because so many people are looking at it. I've seen a lot of news articles coming out and all they're saying is the easiest trade in the market right now is to buy the US dollar. That usually means you're getting close to the end within the next 1 to 2 kind of cents. So we've got to be careful about that. Let's move over to gold now. Gold has hit this pocket zone that we've discussed. It's sitting at 1704. Obviously, we had that kind of 1715 to 1710 range as an area of interest. Now, this is where it's really important that you don't just literally jump in and say, well, I'm going to buy it. If you're a longer term holder, some people do that. The key is to have the patience to react to the market. Just like we did up here where we kind of talked about it becoming weaker, we waited for the structural setup to occur and then it fell into our zone down here. Perfect. That's exactly what we wanted to do. Now we're in what we would call the pocket range. So this area here is where we start to look for reasons that the market might be structuring towards the bull side. At the time of this recording, we actually have none. We have not seen anything change really on the smaller time frames. If you notice, if we go down to a 5-minute chart, there is very little strength here. We got that initial kind of rally. We've now made the new low. We know orders sit behind here. So this is going to become a highlighted zone for us in the future to really kind of push towards that bullish sentiment. If it does happen, we can probably get rid of that now because we know we're in the pocket range. And this will be a huge turning point, I would say, for gold in the future. We've got the supports over here, we've got the resistances or the supplies, and it's come back and tapped that area. What you're looking for now is structural setup. It may take a few days. This is probably not one that's going to instantly just be like, oh yes, great trade. It's most likely going to start to find its level around non-farm jobs numbers, which happens on Friday this week, 8:30 a.m. on Friday, New York time, just 1 hour before the US stock opens. And anything could happen leading into that. We could even see spikes of the liquidity towards the low side underneath this point here, which would push us into just underneath 1700 is certainly open. Let's wait and watch this market. And of course, as always, we'll be talking about Wall Street's money flow into gold moving forward. So stay tuned for gold. It's right in that pocket, which is interesting. Unfortunately, oil continued to drop. Of course, we had the idea of getting it to about 107, 107.50. It just couldn't do it. Demand is getting belted at this stage, and you can see here this huge drop off in oil. We repeated on the previous video that was probably over due to us making this new low. Recovery didn't quite get to the real shorts, which would have been at 102. That would have been a fantastic short zone. And at this stage, oil is just really going back down, possibly new lows in the future. Be careful here on oil. It's not really a great trade either anymore, at least in my opinion, unless you have a longer term time frame on it, which of course, my opinion for the next 6 months is down. And I've said that several times now on the channel. Let's move over here to Tesla. What's going on there? Well, Tesla broke out of a long-standing channel. At the time of this recording, this will be down into the opening hours in terms of it'll actually make maybe a new low, but probably just be more around this area. The problem with Tesla is if you're taking it based on the channel distance, it would mean that we're going towards filling this gap down here at 250. Here's where the issue happens, the indices. Once we start looking at the Nasdaq and the S&P 500 very soon, I'm not sure whether Tesla has false broken that low. And we'll talk about that in just a couple of seconds. Let's move over to Apple. Apple's still holding the gap zone. So we talked about this 156, 157. We're still there. And at the time of recording, although we might open up down because of Nvidia, we basically are most likely going to hold around this area just for now. Let's move over to the one in question, Nvidia. At the time of recording, after hours, it was at 141. So right back into the support. Notice the blocks down here. If Nvidia swipes those areas, so this is the price of 134, there could be some initial like kind of buying around that area. Be careful here on Nvidia. It's one of the most sold stocks on Wall Street at the moment. And that's because it's a mixture of valuations and who knows, maybe they knew a little bit more than we did about that ban that just happened there in the last 24 hours. So Nvidia right on the support, right on the demand zones at this stage. Let's move over to the DAX weakness. The DAX literally fully rejected there on the weekly. If we go into a 1 hour chart, it seems like the DAX kind of front loaded the rest of the market. It was the only one that gave us a potential short. The previous supports were hit with a resistance. It's back down to the lows and it's really now or never for it to hold up. If it doesn't hold here, next level, 12,450 for the DAX, you would think. Again, I still use the US stock market the most for this. Here's a chart that we haven't brought up in a while. This is a big one. This is the QQQ, so the Nasdaq versus the SPY over the last kind of 20 years. And what you'll notice is that it's always held this trendline ratio. We used it back in June and July to find us the lows on the QQQ. Will we find that it bounces this level again? Well, of course, it's coming back down to this trend line. We'll be watching. And this is a pretty important chart and a very important ratio to have on your charts moving forward. Speaking of the Nasdaq, we're in the pocket. So basically we reached the trend line component in the previous session. We did rally a little bit, then fell off during the opening, and we've hit the more statistical likelihood zone for the market to start to structure up. This is a critical zone. From the top now, let's actually just measure this together, guys. This is a big drop now. It's 11.76%. Luckily, we knew that at this point, the weakness was in. Of course, we've tried to navigate as best we could, the little bit of a longs off here, the market down, and this has now hit what I would call a zone that's even better than this one over here. This was a key zone, there's no doubt. Resistances, supports, and we saw that little bit of a bounce. This is where we now want structure to form. And it'll make sense when we look at the Nasdaq in just a few moments. But we have resistances across the board, supports, demand orders, all sorts of things. The head and shoulders has fully completed here. There's a lot to like about this level. The question is, how does it structure up now? Does it swing that low here? Does it instantly bounce off this? In my usual kind of way of thinking about these markets, in general, FOMO doesn't usually pay. So is it at a key support? Absolutely. Is this a key level? Yeah, for sure. Usually the market kind of sets up in such a way that it structures a key level. Similar to over here where we saw that structure, that test, and it gave you that second chance to get back in for that little bit of a bullish move. That's what we're hoping for here. And we'll talk about it in the context of the SPY now to figure out where it's going to next. S&P 500, the last move, it's in the golden pocket. 61.8 to the 66 guard number. This is called the golden pocket. We just hit the golden pocket, and at the time of recording, we went down to a 39.20, realistically getting that gap. Now, I expect to get the gap in the real market. That is, the market should try to close that area, which sits at 39.20. And this is where we're hoping for structural setup ahead of non-farm payrolls. Where's the next level should the market actually bounce? Where you would really hope for it to come back to 40.90 or 41.25. Those two key zones that we'd like to re-short off. This would be a perfect swing scenario in this market, and I kind of hope it happens. I mean, it would make a lot of sense. We still really want it down into these levels because we want to fill the gaps that are left here. But in terms of just like an absolute sell-off, if it's going to find support, this is the place that we would hope it structures up. Here's some of the reasons why. We've got, of course, a whole bunch of lines here that aren't going to make sense to you straight away. But let's just say that this is a very heavily closed on level. This is a gap zone. And of course, we know that already 41.25 and 40.90 are key critical zones in this market. And really everything in here was, let's call it, a little bit lackluster. Of course, we had the 50% fib of the whole move. We had a potential structure in the previous video. We just didn't get enough really strong reasons. And I think this really shows you why patience, and if you have more of a patient kind of mindset, you don't have to trade every day. You don't have to trade every day. But if you find the key levels like we're at right now, this is where you start to say, okay, this is where my statistical chances start to change and start to move. If you now see the right structural setups, potentially there's opportunity. Of course, you could lose anything. Nothing's 100%, but it's at that right zone at the right time for something to happen. Let's take a look now at the options, and we'll refresh these to see what our new max pain level is. And it is 401. So certainly coming down quite a lot. We've got the 390 here. Well, this is the 31st. We'll go over to this one, 409. So we've got the 400 puts. We've obviously got a whole bunch of puts now sitting underneath. Unlikely most of those pay. 390, not really too critical. 409's max pain. So we're about 200, almost 200 points or 20 points away from the maximum pain this week. That's fairly significant. I mean, it basically points towards the pain trade being the upside. We're at the support. So options are kind of starting to agree with that potential that we rally down in this position. This is not a third week options expiration week. These don't mean anywhere near as much. Look at the order sizes, 50,000 units. It's not that much. During really key weeks, almost every one of these spikes is 200,000 or at least 150,000 contracts. So just remember, we're not at a key week yet. We do know that we're going into, of course, a big holiday in the US. We've got the Monday off. Everyone comes back from the Hamptons next week. So the shenanigans begin. Could we be seeing that bullish turnaround at this level? And that doesn't mean that it doesn't go lower later. It's just, this is the key where the buyers may find themselves. We'll go over to crypto now. Now, crypto holding up way better than the stock market. It's like a beast compared to the stock market at this stage. 20,130. Bitcoin hasn't broken through with a closure above this 20,500 zone. If it does, the key levels remain 21.6, which I would really like it to get to, or that 21,000, kind of flat. These are the two key areas. Ethereum already broke out in the previous session. If we saw Ethereum and you have a look at this, we'll just get rid of that. Overall, we have this strength that's in Ethereum. After making those bases, it came down, find buyers here. It's found a few buyers recently, and it's moving towards that 1700 kind of zone. So will Ethereum be front loading the stock market here? They're certainly holding up better than stocks overall. If you haven't already, come and follow us over at FX Evolution on Twitter. Of course, join our Discord community. Over 10,000 people in there in the public community, private community as well. 7-day free trial, and the links down in the description below. And just remember, there's a whole bunch of information still coming out. We have ISM Manufacturing PMI coming out 10 a.m. New York time on the Thursday. And then the big one, Friday, non-farm employment change. If you haven't ever seen a non-farm, often the first move is the false move and then it reverses it. Non-farm payrolls are well known to spike the market towards liquidity levels. So be careful. Fear will probably ensue around this, and then it will often go into the opposite direction. And yeah, it's a very interesting time to be in these markets. If you did enjoy the video today, please subscribe, smash that like button, guys. And of course, if you're interested in finding out any more about Tiger Brokers special offers, you can do so by clicking the links in the description down below. Bye for now. See you soon.